Microsoft is a $3.15 trillion company built on one of the most successful pivots in corporate history. In 2014, Satya Nadella took over a company that was missing the mobile revolution and facing irrelevance, and turned it into the world's most valuable enterprise software business.
The transformation was conceptually simple but operationally extraordinary. Nadella moved Microsoft from selling software licenses to selling subscriptions, from owning the PC to owning the cloud. That shift compounded a 45% operating margin on $245 billion in revenue.
Bill Gates and Paul Allen founded Microsoft in 1975 to write basic interpreters for early personal computers. The insight that every PC would need an operating system made Gates the youngest billionaire in history when Microsoft IPO'd in 1986 at a $21 offering price.
The Windows and Office era made Microsoft a trillion-dollar business and also nearly destroyed it. By 2013, Microsoft had missed mobile, missed search, and missed social. The stock had gone nowhere for 14 years, while Apple and Google rewrote the technology landscape.
Azure launched in 2008 almost as an afterthought. It would take Nadella, who ran Azure before becoming CEO, to recognize that cloud wasn't a product. It was the new foundation of enterprise computing. Azure now holds 23% of global cloud market share and is growing faster than AWS at comparable scale.
The GitHub acquisition in 2018 for $7.5 billion looked expensive. In hindsight, it was the cheapest $7.5 billion in tech history. GitHub's 100 million developers are a direct pipeline to Azure. Developers who build on GitHub deploy to Azure at 4 times the rate of non-GitHub developers.
Then came the $13 billion OpenAI investment in 2023 and Copilot. Copilot AI is now embedded in Word, Excel, Teams, GitHub, and Azure, and it crossed $4.6 billion in annualized revenue faster than any enterprise software product in history. That's the fastest $1 ever recorded.
LinkedIn, acquired for $26.2 billion in 2016, has become a $16.4 billion annual revenue business that most people underappreciate. It's the world's largest professional database, 1 billion members whose activity feeds AI-powered talent search, sales intelligence, and B2B advertising.
The business model breaks into 3 segments. Intelligent Cloud, Azure, SQL Server, GitHub, generates $105 billion and is the growth engine. Productivity and business processes, Microsoft 365, Teams, LinkedIn, generates $80.9 billion in the world's stickiest enterprise subscription.
And the financials reflect the quality. Operating margin hit 45% in FY2024, a record for any company at this scale. Free cash flow came in at $74.1 billion, a 30% margin. That cash generation is what funds $24.7 billion in annual dividends and a $60 billion buyback program simultaneously.
The dividend record is 21 consecutive years of increases, from $1.84 annually in 2019 to $3.32 in 2024. The consistency of the increase reflects the underlying cash flow durability of a business, where 400 million enterprise seats renew automatically.
On the competitive radar, Microsoft scores 92 on both enterprise lock-in and AI integration, the highest in our peer comparison. The enterprise lock-in score reflects something structural. Switching from Microsoft 365 means rebuilding every email workflow, every spreadsheet, every Teams channel, every SharePoint repository. Almost no organization ever does it.
The global network is 60-plus Azure regions, 190 countries served, and 1 million-plus enterprise customers who have embedded Microsoft into their core operations. That footprint is the distribution infrastructure for AI deployment. Copilot reaches 400 million seats the day it ships.
Satya Nadella grew up in Hyderabad, earned engineering and computer science degrees, then an MBA from Chicago Booth. He joined Microsoft in 1992 and spent 22 years running server products and cloud infrastructure before taking the CEO chair. He is the single most consequential enterprise software CEO of the past decade.
Microsoft under Satya Nadella transformed from a software license company into a recurring revenue machine. Azure, Microsoft 365, and now Copilot AI create a stack of switching costs that enterprises embed into every workflow before they realize they can't leave.
The question for Microsoft investors is whether the OpenAI partnership compounds the advantage or creates dependence. If Azure becomes the default infrastructure for AI deployment and Copilot becomes the default AI productivity tool, the next decade of enterprise tech spending flows through the same platform, and the valuation reflects that optionality.
Microsoft reported Q3 FY2026 revenue of $82.9 billion, up 18% year-over-year and above consensus. Adjusted EPS of $4.27 beat $4.03 by 6%. Azure grew 40%, with AI services now contributing 16 percentage points. The AI annual run rate crossed $37 billion, up 123% year-over-year. At 28 times forward earnings, Microsoft is the enterprise AI compounding machine.
Microsoft Corporation was founded in 1975 by Bill Gates and Paul Allen and became the defining software company of the personal computing era. Today, it operates through three reporting segments: productivity and business processes, encompassing Office, Teams, LinkedIn, and Dynamics; intelligent cloud, anchored by Azure and server products; and more personal computing, covering Windows, Surface, and Xbox. CEO Satya Nadella, who took over in 2014, reoriented the company around cloud-first, mobile-first, and most recently AI-first strategy.
At approximately $3.1 trillion in market cap, Microsoft is among the world's two most valuable companies alongside Apple. Trailing revenue exceeds $320 billion on an annualized basis. The OpenAI partnership, Microsoft holds approximately 49% economic interest, is the central AI infrastructure bet that distinguishes Microsoft from every other enterprise software platform.
Q3 FY2026 revenue of $82.9 billion beat the $80.9 billion estimate, a 2.5% outperformance. Total revenue grew 18% year-over-year. Adjusted EPS of $4.27 beat $4.03 by 6%. Intelligent Cloud segment revenue reached $34.7 billion, up 30%, driven primarily by Azure and AI services.
Azure grew 40% in the quarter, with AI services contributing 16 percentage points of that growth, up from 13 points in Q2. Microsoft Cloud overall reached $54.5 billion, up 29% year-over-year. The AI annual run rate crossed $37 billion, up 123% year-over-year. Satya Nadella noted on the call that Azure capacity constraints are easing as data center builds accelerate.
Productivity and business processes revenue reached $35 billion, up 17%, driven by Office Commercial Cloud growth and LinkedIn revenue. More personal computing came in at $13.2 billion, down 1%, as PC demand remains subdued. The segment-level story is clear. Cloud and AI are growing double digits. Legacy PC is stable, but not a growth driver.
Operating income reached $38.4 billion on a 46.3% operating margin, up 150 basis points year-over-year. Microsoft continues to expand margins even as it funds the AI infrastructure ramp, demonstrating operating leverage that most cloud peers cannot match at this scale. GAAP net income was $25.7 billion.
Capital expenditure reached $31.9 billion in Q3, including finance leases, up significantly year-over-year as Azure data center build-out accelerates. Free cash flow compressed to approximately $15.8 billion as a result. Operating cash flow remains strong at $46.7 billion. Q4 FY 2026 guidance was raised to $86.7 to $87.8 billion, above prior consensus.
Capital return remains disciplined. $4.6 billion in buybacks executed in Q3 under the $60 billion authorized program. The quarterly dividend was raised 10% to 83 cents per quarter, 33.12 annualized. The stock dropped approximately 1% after hours despite the beat, reflecting investor focus on CapEx compression of free cash flow.
Satya Nadella joined Microsoft in 1992 and spent over 2 decades leading cloud and enterprise engineering before becoming CEO in 2014. His tenure transformed Microsoft from a stagnant PC-era incumbent into the dominant enterprise cloud platform. The OpenAI partnership, Azure AI Stack, and Copilot ecosystem are the signature strategic initiatives of the Nadella era. the largest bet on AI infrastructure ever made by an established technology company.
Analyst consensus heading into Q3 FY2026 was approximately 47 buy ratings, 3 holds, and 0 sells, the most unanimous bullish stance of any large-cap technology company. The average price target was approximately $585, representing 38% upside from the current price. No analyst downgraded following results despite the after-hours decline.
The bull case among analysts centers on Azure AI compounding. At 28 times forward earnings, Microsoft is pricing in Azure growing above 35% through fiscal 2027. AI services now contributing 16 percentage points of Azure growth means the business is generating AI revenue at scale, not just talking about the opportunity. Analysts argue that Copilot penetration into 345 million commercial M365 seats at $30 per user per month is a multi-billion-dollar incremental revenue stream in early innings.
Morgan Stanley maintained outperform with a $600 target, arguing that Azure's capacity constraint easing in the second half of FY 2026 will drive re-acceleration above 40% growth. Each data center that comes online converts backlog into recognized revenue. The visibility into demand is exceptionally high for a hyperscaler.
More cautious analysts focus on the CapEx burden. At $32 billion per quarter in infrastructure spend, Microsoft is investing more than many governments. If Copilot adoption plateaus in the single digits, reflecting enterprise resistance to paying $30 per user per month, the AI investment cycle produces insufficient return on incremental capital.
The Q3 consensus takeaway: the Azure acceleration validates the AI infrastructure investment thesis. 16 of 40 percentage points of Azure growth are AI-driven, meaning AI is not a marketing overlay, it is a material revenue driver. Analysts expect this trend to compound as Copilot Enterprise seats expand and Azure AI services deepen.
The bull case is an enterprise AI compounding argument. Microsoft has 345 million commercial M365 seats, paying Copilot premiums at $30 per user per month. Even 10% penetration, 35 million seats, generates over $12 billion in high-margin annual revenue. That alone covers a material portion of the AI infrastructure CapEx without requiring new customer acquisition.
Azure AI services at $37 billion annualized is growing 123% year over year. Every percentage point of Azure growth that AI services contribute is structurally stickier than commodity cloud compute. Enterprises building Copilot workflows on Azure create multi-year switching costs. The moat compounds with each enterprise integration.
The capital return amplifies the thesis. A $60 billion buyback plus 10% dividend growth at 46% operating margins means Microsoft compounds per-share earnings without requiring multiple expansion. Even if the multiple contracts from 28 to 24 times forward, per-share earnings growth of 15 to 18% can deliver double-digit total returns.
The bear case starts with CapEx. At $32 billion per quarter in capital expenditures, Microsoft is running one of the largest infrastructure investment programs in history. Free cash flow compressed to $15.8 billion in Q3, a fraction of operating cash flow. If Azure growth slows below 35% while CapEx remains elevated, the free cash flow yield at 28 times forward earnings becomes unattractive versus the risk profile.
Copilot adoption risk is real. Despite 345 million commercial M365 seats, penetration remains in the low single digits. Enterprise buyers are cautious about paying $30 per user per month for productivity improvements they cannot yet quantify. If adoption plateaus, Microsoft's AI revenue growth slows to legacy software rates even as CapEx runs hot.
Competitive risk from Google Cloud is accelerating. Azure grew 40%, Google Cloud grew 63% on a smaller base. Google's Gemini integration into enterprise workflows, combined with aggressive GCP pricing, is targeting exactly the AI-native workloads that Microsoft is counting on for Copilot revenue. The enterprise trust advantage Microsoft holds is real, but not permanent.
Regulatory risk in Europe is a latent overhang. The EU AI Act, ongoing antitrust scrutiny of the OpenAI partnership, and data sovereignty requirements in Germany and France could slow Copilot deployment in Europe, Microsoft's second-largest market. Each delay pushes revenue timing further out.
The direct cloud peer, Azure at 40% versus AWS at 28%, and Google Cloud at 63%. Microsoft is in the middle of the cloud stack, faster than AWS, slower than GCP. The valuation premium over AWS reflects enterprise software bundling. The premium over Google reflects Microsoft's lower regulatory risk and deeper enterprise entrenchment.
The productivity peer is Salesforce. Microsoft Teams has largely displaced Salesforce's collaboration ambitions, and Dynamics is eroding Salesforce CRM in mid-market accounts. At 28 times forward earnings, Microsoft trades at a meaningful premium to Salesforce at 22 times, but Microsoft's AI integration across the entire enterprise stack makes the premium defensible in a way that a single application vendor cannot match.
Apple is the market cap peer. Both are approaching $3 trillion in market cap, but Microsoft's revenue growth at 18% dwarfs Apple's mid-single-digit growth. Microsoft trades at a similar PE to Apple, despite faster growth, suggesting the market has not fully priced the AI monetization opportunity embedded in Copilot and Azure.
Meta is the digital advertising contrast. Both are deploying massive capex into AI. Microsoft at $32 billion per quarter, Meta at $25 billion. But Microsoft's AI monetization is enterprise subscription-based, while Meta's AI supports advertising efficiency. Enterprise subscription revenue is more durable than advertising-dependent AI monetization.
Pre-earnings options positioning was broadly bullish. The put-call ratio settled near 0.68 in the week before results. Despite the slight after-hours decline, institutional options flow showed call buyers targeting the 440 and 450 strikes for June. This positioning suggests the dip was interpreted as a buying opportunity rather than a fundamental shift in the Azure thesis.
The post-earnings options flow is directionally instructive. Calendar spread buyers positioning for Azure reacceleration in Q4 FY2026 outnumbered put protection buyers. The signature of this flow is institutional investors with visibility into Azure capacity coming online. They are positioning for Azure growth to reaccelerate as supply constraints ease in the back half of the fiscal year.
Insider activity at Microsoft is structurally clean. No material open market sells were reported from CEO Satya Nadella or CFO Amy Hood in Q3 FY2026. The $60 billion buyback with $4.6 billion executed in Q3 is the operative signal. Management is actively reducing float at current prices. This signals confidence that earnings will grow into the multiple.
The 10% dividend increase to 83 cents per quarter positions Microsoft for income investor ownership at scale. A company with 46% operating margins raising its dividend 10% while executing a $60 billion buyback is signaling both earnings quality and management confidence. The combination of dividend growth and buyback execution is compounding shareholder returns independent of multiple expansion.
Microsoft delivered a clean beat. Azure at 40%, with AI contributing 16 points, margins at 46%. The AI flywheel, Copilot drives M365, M365 funds Azure, Azure powers enterprise AI, is compounding.
Risks are real. CapEx treadmill, Copilot adoption pace, and GCP competition. At 28 times forward earnings, the multiple is demanding. Watch Azure growth and Copilot seat disclosure as the two critical quarterly metrics.
Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching.